When I first started my journey in the financial market, I lost everything in my account. I lacked the necessary investment skills, but fortunately, I improved. And now I'm a multimillionaire with financial freedom. And I'm giving you the short version. There's a lot more to this story, but my secret, it's not just my investing skills. Though I won't lie, I work incredibly hard, but my investments have made the process of becoming wealthy easier. There are essentially two ways that investing can help you achieve the dream of becoming a multimillionaire or very wealthy. The first way is by investing over a long period of time. However, many people lack the patience to wait 30, 40, or even 50 years to reach a certain financial level. The second way is by accelerating this process through smarter investing. In other words, you need to find ways to increase your returns. So, the question you need to ask yourself now is, what can you do to boost your investment returns? Think about this logic with me. The more knowledge you have, the better you invest. The better you invest, the higher your returns will be. The higher your returns, the greater your future wealth will be. The greater your future wealth, the more likely you'll build passive income that covers your expenses and provides comfort. And the stronger that passive income stream, the closer you'll be to achieving your dreams. But it all starts with one thing. To invest better, you need to invest in knowledge. That's why in today's video, I'm going to share a wealth of knowledge with you. I'll present 5 ways to boost your investment returns and never be broke anymore. And please don't forget to like, subscribe, and leave a comment. The first thing you need to do is manage your priorities. Let me walk you through a rough calculation, just as an average. No need to stick to the specifics. A day has 24 hours. You sleep around 7 hours a day. You spend about 2 hours in traffic, adding breakfast, lunch, dinner, and showering. That's another 2 hours. The average employee works around 8 hours per weekday. So subtracting all of that from your 24 hours, you're left with 5 hours. These 5 hours are yours to do whatever you want. You can use them to read a book, spend time with family, go to church, hit the gym, or visit your mom. The point here is only 12.5% of your day is truly yours. The rest is either sold or spent on others. Therefore, time is the scarcest and most valuable asset you have. Here's what many people who invest start doing. They take those only 5 hours they have each day. They buy finance books. They listen to investment podcasts. They watch 20 YouTube videos a day. And they spend those precious few hours searching for investment hacks. And don't get me wrong, it's great to dedicate part of your day to investing and finding ways to make more money. But if you're not like me, who works with finance and investments, it might make more sense to manage your priorities. Let me give you an example. If you have a lot of time, you can do evaluation and invest in the most undervalued companies on the stock exchange. If you have a bit less time, you can do a screening and choose assets with the best indicators. If you have less time, you can invest through ETFs that replicate the main stock indexes. Now, you might be wondering, will I still get good returns if I invest in ETFs? The answer is absolutely. In fact, consistently beating the market by picking individual stocks is extremely difficult. Take a look at this graph. Only exceptional investors like Warren Buffett can consistently outperform the S&P 500. There are several ETFs that track the S&P 500, such as SPDR S&P 500 ETF Trust, iShares Core S&P 500 ETF, the IVV, Vanguard S&P 500 ETF, the VOO, SPDR Portfolio S&P 500 ETF, the SPLG, the Invesco S&P 500 Equal Weight ETF, ETF, the RSP. So, if you don't have the time or interest to dive deep into stock analysis, simply investing in an ETF could be your best move. Second, be a Deb account. Years ago, a study was conducted within the financial market by researchers and accountants at Fidelity Investments, a prominent US investment management company. They decided to examine the performance of each account under their management to uncover why some clients achieved better returns than others. They analyzed various factors: small cap stocks, large cap stocks, domestic stocks, foreign stocks, whether the portfolio had high turnover or low turnover. They literally examined everything they could. After months of poring over the data, the Fidelity team made a shocking discovery. There was one type of account that consistently outperformed all the others. Can you guess what kind of account it was? Debt accounts. Yes, inactive accounts belonging to people who had passed away. It turns out that those who didn't constantly buy and sell stocks ended up with better long-term returns than any other type of account. So remember this: investing is like a bar of soup. The more you handle it, the smaller it gets. Third, buy in crisis. The first point I want to share comes from a guy named Charlie Bilello, who made an interesting observation on X. He noted the Nikkei 225 index in Japan dropped 17.5% in the last 2 trading days, marking the biggest 2-day decline in history. But do you know what happened to the Nikkei index 1 year after its 3 largest drops? 1 year after October 1987, the market was up 25%. 1 year after October 2008, it was up 43%. And 1 year after March 2011, the market was up 18%. So, essentially, a stock market crisis is almost synonymous with opportunity for long-term investors. And that's the first point. View crises as opportunities. Now, the second point I want to bring up is this. If you look at the Japanese stock market, you see that the Nikkei 225 reached its all-time high, close to 40,000 points back in 1989. I won't dive into the details of what exactly happened, but there was a financial and real estate bubble that burst, and the market only recovered to that historical peak at the start of this year. In other words, if you had invested at the wrong time in 1989, it would have taken you nearly 35 years just to break even. And the worst part, a crisis like that comes along, and in just 17 trading days, the market drops nearly 20%, wiping out all the gains again. So, here are 3 key principles I want to leave you with. First principle: crises are opportunities. Be fearful when others are greedy, and be greedy when others are fearful. Second principle: never go all in at the wrong price. It's crucial to learn the difference between price and value. And third principle: long-term investing isn't always the solution if you bought at the wrong price. Sometimes, even over the long term, you won't recover from a valuation mistake. In Japan's case, it took 35 years just to break even. So remember, long-term investing doesn't solve every problem in the stock market. Never forget that. The fourth way to increase your returns is don't try to predict the future. Let me ask you something. Who do you think would perform better in the market? A person who invests regularly every month, or someone who can predict the future and invests only when the market dips? There's actually a study that compares these 2 investment strategies. The first strategy is called dollar cost averaging, the DCA. With DCA, you invest the same amount of money every month. So, if you have $1,500, you would set aside $125 each month for 12 months and invest that amount. The other strategy is buy the dip, where an investor only buys stocks when the market hits a low point between two historical highs. For example, let's say the stock market was at 100,000 points. Then it dropped to 90,000 points before rising to 110,000 points. In this strategy, you would buy exactly at that 90,000 point low instead of investing consistently each month as you would with DCA. But if the market doesn't dip, you simply don't buy anything. Now, to pull this off, you need a crystal ball to perfectly predict every time the market's going to drop, so you can make your moves. So, if you had a crystal ball and could foresee the perfect times to invest, obviously that would be the best way to go, right? And actually, no. The study's results are right here on the screen. This chart shows the performance of these two strategies over the last 40 years with $100 invested each month in the S&P 500. The black line represents DCA, where you buy every month, and the blue line represents buy the dip, where you only buy at the low point between two highs. What's the takeaway here? The takeaway is that waiting for the perfect moment to buy stocks isn't worth it. Many people in the market are constantly waiting for the perfect time to invest. But the truth is that moment doesn't exist. This study shows that time combined with the power of compound interest is far more important than trying to time the market. Even if you were a genius and could predict every market bottom, you would probably still lose out to someone who simply invested regularly each month. So, invest every month. Don't try to predict the future and don't try to time the market. Regular investing will give you much better returns in the long run than trying to outsmart the market, which, let's face it, is nearly impossible. And the fifth, last but not least, don't focus on profitability. This next part of the video might seem a bit contradictory since the goal is to show you ways to increase your profitability. But now I'm telling you not to focus solely on profitability. But don't worry, because I'll explain. First, let me ask you something. Do you know Warren Buffett's first rule of investing? The first rule from the Oracle of Omaha is never lose money. And the second rule, don't forget rule number 1. But when Buffett said this, he wasn't just speaking off the cuff. There's a mathematical logic behind it. Here's how it works. If you lose 10%, you need an 11.11% gain just to break even. If you lose 20%, you need a 25% gain to break even. If you lose 30%, you need a 42.86% gain to break even. If you lose 50%, you need 100%. If you lose 70%, you need a 233.33% just to break even. And if you lose 90%, you need a 900% gain just to break even. So, when an investment loses value, the percentage needed to recover your initial investment is always greater than the percentage of the loss. Here's the point. Some people get so focused on profitability that they end up building a portfolio full of high volatility stocks, the so-called spicy stocks. But what happens when the market turns? While the broader index might drop 10 or 20%, your portfolio could plummet 40 to 50%. If the market drops 20%, it needs to rise 25% just to break even. But if your portfolio drops 50%, you need a 100% gain just to get back to where you started. So, the best way to increase your profitability is by not focusing solely on profitability. If you ignore the volatility volatility and risk in your portfolio, you're also ignoring true profitability. Well, that's it. I genuinely hope that you've learned something new that you can apply to your investments. If you enjoyed the content and found it helpful, I would really appreciate your support. Please take a moment to like this video, subscribe to my channel, and leave a positive comment. And never forget, your success is my success. Bye bye, and see you next time.